loss on the asset side, which is larger than the equity, so that's defaulting. Now, next step, what you need to do is compare the losses, assuming there is no recovery rate, in the other balance sheets, and then compare to the equity. Fine, at this stage, only one guy defaults, but you need to take into account that there might be also transversal links in the sense that you see bank number 3 is also exposed to bank number 2, and as a result, it's facing an additional loss, which then now makes it larger than the equity. So now these guys are all defaulted, and then you continue recursively until nothing more changes. So this is an exercise that was carried out, for instance, at the end of 2007, and been carried out also during the crisis. And what is the result? Well, usually nothing happens. And well, you wonder why? Well, it's simple, because there are directives according to which banks should essentially not have any of their largest exposures larger than their core capital, which means that whenever there is one default, this is causing not a single any other default, which means that there is no cascade. So then this exercise shows that if you run it, well, it would give you as a result that the system is fantastically robust. However, there are effects that you might take into account in a very simple way, which goes along the following lines. So let's imagine bank number 1 to the left is facing a loss, which is not larger than the equity, so it's only eroding, it's eroding part of the equity, but not entirely, so bank number 1 is not in default. And now you need to realize that what is the value of the obligation of this liability that for number 1 is a liability but appears as an asset on the balance sheet of number 3. So for sure, the value of the obligation cannot increase now that the equity of bank number 1 has been eroded by 80%. It will decrease, that's no doubt about it. By how much? Well, we can discuss, we can make it model it. Let's assume for sake of simplicity it's decreasing proportionally, okay? So that the result is that on this side, there's been now a shrinking of one of the chunks, one of the assets, which means also that the equity of number 3 is decreasing. Again, there is no default. Number 1 has not defaulted, number 3 has not defaulted, but there's been a substantial loss in asset side value and in equity. So now you can apply this reasoning on a network of interlocked balance sheets, as we did before. And for instance, at the first level, what happens is that these guys are losing on the asset side a certain fraction of their asset, which erodes the equity. But then there are the transversal links, which implies that then you have additional losses that are due to the exposure that there are among these guys. And so then you can continue on, and in the end, you get this picture in which essentially nobody defaulted, but there was a substantial loss in the asset value overall in the system. And how do you measure the importance or the impact of a single institution? Well, you just run this procedure, and you measure what was the total loss of value in the end. And then you repeat with another guy, we repeat with another guy, and then you get the systemic importance of every institution. You can actually, oops, where am I? Yeah, so you can actually run this in real data if you have them. So what I'm showing now is a little exercise that we carried out using data from the Fed emergency loans that were granted between 2008 2010. So there is some information about balance sheets, how much the American and European banks were owing to the Fed. There is no data about their mutual exposures, which means that we used a proxy using investments in equity, and we made an exercise which doesn't, has no claim of, oh, this is what really happened, or this is what really would have happened, but at least you learn what could, I mean, how much you could learn had you got the data. So let me on the time series that you see here below is the average market capitalization of the 22 largest borrowers to the Fed in the period 2007-2010. The minimum is at March 2009. And so it's steadily decreasing, then it bounces back. And then what you see on top there is a value that you obtain with this debt rank, which is this indicator that I showed you. I showed you in pictures. There is an algorithm, of course, but I don't have the time to get into the details. And the only thing is that rather than knocking down one bank at a time, you can also repeat the exercise by shocking all the asset side by, say, 10%, and you see what would be the global impact. So you measure the total loss. And this is what you see on the top. So you see that there is a nonlinear response function with respect to the market capitalization. The fact that the systemic impact is increasing is not a surprise. It's actually built in this exercise because we are evaluating the fragility of each bank, taking into account in the core capital. We essentially proxy the core capital, which we don't know, by the market capitalization of the same institution in the same period, of course, which means that when the market capitalization goes down, the size of the core capital with respect to the exposure decreases. That means that if there is a distress of the counterparty, this will have a higher impact, and therefore it's natural that during the moment in which the market capitalization goes to the minimum, the impact of everything that happened is higher, and therefore you have a maximum. So that's not a surprise, it's built in. However, what I'm trying to argue here is that this is a methodology that allows you to quantify what would be the effect. Okay? So if you want, it's a sort of a prediction, but on a very short time horizon. Essentially, you imagine, okay, let's suppose we have all the balance sheet, all the structure, and let's suppose there is a shock on the external assets. What would happen? Imagining that there is simply a unwinding of the consequences without taking account essentially any type of behavior. This is in line with the discussion that we had this morning regarding the various working groups. So a limitation of this type of exercise, and of course you can look at the evolution over time, the limitation of this kind of exercise is that it's very mechanical. The advantage is that you almost have no assumptions about the behavior, which means that apart from the amount by which the obligation of the distressed institution decreases with the amount of equity that has been eroded. Okay? And so we are currently collaborating with some central banks, particularly the Central Bank of Italy, where we are applying this methodology on their data. What you see on the left is the evolution of the network. So, as I said, the links have been taken as our proxies. In this case, these are the largest borrowers. We're including U.S. and European banks, all essentially the usual suspects. And the representation that you see on the left is a diagram where the most important institutions are. The more the institution is important, the more it goes to the center. So the position of the institution is measuring the impact on a scale from 0 to 1. What would be the loss in asset value that would be caused by knocking down that institution? Okay. So let me jump now in the remaining minute that I have to this slide. So what have we learned, or what have we looked at? Okay, the financial system can be represented as a set of nodes and links of various nature. So you've got the, for instance, financial intermediaries investing in external assets, which as soon as they start being the same because portfolios are overlapping, then suddenly you have, first of all, a possibility of contagion through the external assets in the Kiyotaki-Moore sense, if you want, but applied on a network. Then you've got also the exposures between the financial intermediaries, and through these network effects, you can have amplifications of the distress of one into the other. Finally, okay, to have a more complete picture, you should include also governments, who is trying to regulate the whole thing, possibly, and firms, which are related to the external asset, because supposedly at least some of those external assets should be connected to real activities. And let me jump to the, probably to the end. Yes, okay. So, here we go. So, over there, essentially, a research agenda on financial interlinkages, I think, should cover, first of all, the empirical side, so looking at how this network are looking like, because in many cases this is simply unknown, and that has, as you have seen in this example that I showed at the beginning, but there are others. I could show you many other examples. The structure has an implication, has an effect. Not only the structure has an effect, but also the way the way distress propagates that from a node to another. And that depends on the capital structure, depends on the ratio, for instance, between core capital and then the exposures. That's part of the node dynamics and the propagation and the link formation. Then there is a part which is seldomly covered, which is the evolution of the links. That's something that, for instance, we've covered also with Mauro Napoletano in the past, but that was in a different context. And obviously there, the issue you want to look at are the structure that emerge efficient from a social welfare point of view. And finally, let me mention that there is, however, this part, which is very rarely, to my knowledge, taken into account, the feedback from the structure onto the incentives. So you get that generally the financial system, thanks to the network, its network nature, tends to form a core periphery structure with a core which is very densely connected, tends to include the most important actors in the market, which then inevitably accumulate an enormous influence on the debate and on the discussion of what regulation should be put in place. And so this is a political economy aspect which I never seen very much taken into account. And in terms of who is doing what, well, these are some projects that I'm aware of. So the FOC project is a European project dealing with the first type of question. There are a number of INETS grants that are also dealing with that. There is an issue of networks or networks of different types that may interact in the network of external assets, the network of interlinkages between intermediaries. And there is a starting European project on interacting networks, but that's it's only partially focusing on economic networks. And then finally, in one of the working group of the task force, the one on interlinkages, one of the lines we have decided that we'll be dealing with this political economy aspect of the feedback between the structure and the formation of the incentive. I'll stop here and take any question.
Yeah, I think there's time for maybe 3 or 4 questions. Yep.
So if I got it right, you are assigning...
Do you want to just use the microphone there so you can...
I think I can speak up.
Yeah, but then your voice won't be recorded, I think.
I can hear you. I can hear.
It's for the tape.
Okay, sorry. Oh, okay.
Very professional. Okay, thank you. Does it work?
No.
No.
Okay, now,
But it's taped.
now it should work.
Does it work?
Yeah,
Yeah.
now yes.
Okay, so if I got it right, you make some assumptions on the interlinkages between banks in order to go on with your exercise.
So
Because you don't have the complete data. So you have some assumptions there. So would it be possible to make the assumptions in such a way that the distress is maximized or minimized? That could be a nice benchmark to have. For instance, you see the assumption under which you have maximum damage when something goes wrong.
Yes, but probably the answer is trivial. So the question is not, but the answer will be. So first of all, there is a recipe, assuming you have the data, and some people do have the data. So the central banks, for instance, they have complete, in some countries, they have complete information about the exposure, so they can run the exercise with the good recipe, which is in this slide. Then, if you don't have the data, well, try to come up with a proxy. Now, it's interesting what you're saying, that look for upper bounds and lower bounds. Well, but it's a bit obvious what they are, in the sense that in terms of no matter essentially how the linkages are organized, if I make, let's say, if I make a ring where everybody has its exposure to the next guy larger than its core capital, it's just a chain, it goes down, everybody goes down, it's full collapse. If you make a network where everybody has very, very little exposure compared to the core capital, that's safer. But that's, I mean, it's quite obvious. However, what you learn is that if it is a complete graph, at the first round, nothing happens. But if you, because of the interlinkages between all the guys, then you have a second round effect, which is actually something that maybe you didn't think in the first place. And maybe a good point would be to measure what is the effect of the second round effect.
So Oliver had a question there. Next. Yeah.
Thanks. It's really interesting. It's been quite a productive area of research since the crisis. One thing I think is worth taking into consideration is that these interbank networks have changed enormously since the crisis. When the crisis hit, banks had large unsecured interbank exposures. But those financial exposures are far smaller now and less secured than unsecured. And I think you need to take that into account when you're talking about policy prescriptions for the future. Because in Europe, at least, the market's changed enormously in response to the problems you're pointing out.
So yeah, so if I got right, there's someone who wants to have another comment. But yeah, let me try to answer to that. This is the reason why I presented not just the. I wanted to stress the fact that you shouldn't look only at the network of interlinkages between the balance sheets, but also the external assets. And I didn't have the time to show, but you can also. There are examples. Sorry, you can also bring in the. Here it is. On the liability side, the short-term lenders. This is the work that we've done last year with Mauro Gallegati and also with Joe Stiglitz. So essentially, there are many things there are different types of actors and different types of links that you can take into account. And at the moment in which, for instance, the interbank market dries up and disappears, well, other channels may take over in terms of where the distress may propagate. I don't know if that answered your question. So in the sense that in this way, you can start looking at whether some external assets could be encumbered, for instance, but that's something that you can look. I mean, you have to take into account in another setting.
So next question. Yeah.
Okay. I'm Giovanni Diasio from the Bank of Italy. I'm one of the co-authors of Stefano about some project. We are using the depth rank algorithm on real exposures. So we have the metrics of data, bilateral exposures, and we are trying to expand, to enlarge the depth rank algorithm methodology. That is essentially one way to microfound the idea of distress that go through channel other than solvency. That is the main idea of default cascade. And so we have results on the depth rank algorithm on real data, and then we are trying to understand which may be other ways of contagion that goes through the liability side of the banks. I mean, through liquidity risk. And so if one bank goes burst, maybe some other banks that were taking money from this bank they have to roll over some. They have to find some other funder for this part of the liability side. And it's just what Stefano was trying to say. We are trying to understand which may be the effects of this shock on the funding of the banks. So you can use some unencumbered asset to go to the ECB, or you may curtail short-term lending. And we are trying to understand all these issues in a coherent framework.
Okay, that was a fascinating talk, Stefano. Thank you very much. We don't have much time for questions, but if I talk really quickly at the end, we'll have more time for questions. I promise that I will do this. And so we'll hold off the questions for now, and I'll just pass over to Gennaro Zezza.
Thank you, Stephen. I have a very long presentation because I was not sure what kind of audience I would have, and I chose not to present formal models because I think that in 15 minutes you cannot really convey the technicalities of a formal model. And I will talk about the European crisis, the current crisis, and the methodology that I adopt to try to understand how it works. And the phase dichotomy I chose, so is austerity and growth, which are presented in Europe as something that can and should go together, and I will show that this is not the case. So I will jump several of my slides, and I hope Stephen will keep track of the time. Yep. But we can go back to them when needed. So the idea, in my view, behind everything which has been happening in the last 25 years is that there are three drivers of so-called neoliberal policies. One is that redistributing income to the top would benefit everyone. The second one is that deregulation of financial market will allocate risk better. And the third one is that government is inefficient. So if you privatize, the well-being for everyone will increase. And even though I believe, and there is ample evidence, I think, that this has not worked very well, they are still behind much of the current policies. So I endorse a view of the crisis which I think is now more and more accepted, which links the increasing borrowing of US households and European households in many countries as the result of the stagnation of wages, which was itself a result of the widening distribution of income towards the top, of imitation effects in households which try to defend their living standard on the face of rising cost of healthcare, education, especially in the United States, which led to a willingness to borrow, and on the other hand, on the deregulation of the financial market, which brought to a willingness to lend, and that created financial bubbles. So I can jump this, which is well known. And if we concentrate on the Eurozone, I think it is important to notice that many countries did benefit from joining the euro if we measure this as the increase in their income per capita. So all these rows, apart from the last one, compare the GDP per capita in each country with respect to Germany, and the last one gives the increase in Germany's GDP per capita. And you can see that countries, especially Greece and Ireland, which are now in deep trouble, had a great increase in their income per capita. So this is something that will be useful later. So at one point, it was decided that the debt problem, the public debt in Europe was a problem. And this started with Papandreou, which admitted that the Greek government statistics had been mishandled and that the deficit was larger than it appeared. And this started the crisis of confidence against the Greek government, which then trickled to other countries and so on. And what the interpretation of what that is provided by the mainstream in Europe is that this debt crisis is the result of the countries in the periphery spending too much, having too high pension, wages were too high in the public sector, and so on and so forth, while the virtuous countries of Germany, which had kept wages low and had relied on export-led growth, did very well, so they had to be imitated. And this called for shrinking the deficit on the one hand and introducing more labor market reforms or cutting down wages, cutting down pensions, and so on and so forth, while it was prohibited to the ECB to provide direct finance to the government, even though various measures of indirect financing were then put in place, but never to make sure that government could borrow directly from the central bank and therefore could obtain a very low interest rate. So I hope to show that this approach will not restore growth, but it is implying a major shift in the distribution of income and wealth. So this mainstream interpretation needs that the large debt was the ultimate cause of the crisis, but if we look at the data, it is not the case. So this is the gross debt of the general government, and in yellow you have the so-called PIIGS countries. In 2006, before the crisis, they were not particularly high historically, but they increased after the crisis, and of course this was as a result of the crisis. And you have similar data for the general government net lending and the primary surplus. Many of these countries had a primary surplus before the crisis hit, but when a crisis hit, you all go into a deficit. We can examine the dynamics of the debt to GDP ratio with very simple algebra, which I think everyone knows very well, which points out two interesting things. One is that the relation of the nominal interest rate on the nominal growth of GDP is relevant, because if GDP is not growing and the interest rate is high, then you have an automatic increase in the debt to GDP ratio if you have a zero primary balance. If you want to use this algebra to understand what kind of primary surplus you need to stabilize the debt to GDP ratio, you must understand which relation there is between the primary surplus and the growth of the economy, because it cannot be the case that the growth will be invariant to the fiscal policy. So the arguments for austerity and growth basically rely on an idea of the fiscal multiplier being zero or even negative. So there are several ways you can get there. One is the well-known Ricardian equivalence. If you add to that the inefficiency of the public sector, then you can think that the increase in government is actually making damage to the economy. If the government shrinks, there's more room for the private sector and the economy will grow, and so you can have both austerity and growth. So can this possibly be working? I think I can jump this on Italy. Maybe this chart is interesting, which is comparing the implicit interest rate on government debt against the nominal GDP growth rate, and you can see that the interest rate has been an important component of the growth in the Italian GDP in the Italian debt to GDP ratio. And you can also see by the analyzing history that a very high debt to GDP ratio was never a problem in Italy or other countries, as long as GDP was increasing at a reasonable rate and interest rates were low relative to GDP growth, and the tax base was more or less in line, the tax inflow were more or less in line with growth in GDP. Problems started in Italy when the interest rate became too high and the tax base started to erode, especially with the Berlusconi government. The other problem, which has been hidden for a long time in the European discussion, is that of trade imbalances. It is now well recognized that Germany pursued an export-led growth strategy by keeping wages quite low. And on the other hand, the access to European funds allowed peripheral countries to finance expenditure out of borrowing, although this is not so clear, because if you look, for instance, at the average interest rate paid by Spain on borrowing, it is true that this went down, but if you look at the prime loan paid by Spanish firms, the difference is not so dramatic. So anyway, what happened is that Germany, with the fixed exchange rate given by the euro, was able to increase dramatically its exports to, especially to other Eurozone countries. And Italy suffered this against Germany. The same happened to Greece. But it is not clear from the data that Italy is suffering overall from a lack of competitiveness, because if you look at the bilateral surplus against the US, this has not decreased so dramatically. And also the trade with the other Eurozone countries does not seem to decline so dramatically in the euro area. So the current account problems of Italy were not necessarily given by low productivity and so on. So already very much behind. But what is relevant is that when you start having a large trade imbalance or current account imbalance, this requires borrowing from abroad, and therefore this implies the accumulation of debt held abroad. So finally, to the core of my presentation, if we make very simple assumptions, some are accounting assumptions that must held true, such as that the debt is a credit for somebody else, and you look at the composition of the public debt given by how it is distributed between domestic holders and foreign holders. If you take into account that that implies a future stream of interest payment, which will decrease income for the debtor and increase income for the creditor, if you recognize that foreign capital, which is something that everyone is looking for in Europe, we want more foreign investment into our country. Yes, but foreign investment implies a future stream of profits going out of the country. If you take all of this into account, it becomes quite clear that the debt management is about how to redistribute income and wealth. We adopt the stock flow consistent approach, and this is a matrix which can be used to address these problems. As I said, I don't want to go into the formal details, but this is has been presented at least 2 or 3 times in the last 2 days. It is showing who is paying, which sector is paying and which sector is receiving. This particular matrix has the so-called 99% and the 1% in households, and because several analyses show that the 1%, or if you prefer the 5%, hold the large majority of financial assets, and so therefore are the recipients of dividends and interest income. If you add the rest of the world, you can track dividends paid abroad, you can track income generated by export, income going abroad because of imports, and so on. So if you add to the accounting structure some simple realistic assumptions on behavior, such as that workers, or if you prefer the 95%, spend a larger share of each euro they get against the 5%, which is exactly what Lance Taylor was presenting today. If you add the determinants of trade and so on, then it is quite clear that what austerity will imply is a reduction in the income of taxpayers, which are all domestic, and an increase in transfers through interest payments to the holder of the debt, which in many peripheral countries are abroad. Therefore, the effect on aggregate demand through this channel cannot possibly be positive, but as long as this continues, it will be to depress demand. On top of this, if you don't allow the ECB to finance the government directly, then interest rate will rise as soon as a country is unable to have a large enough increase in its tax base. So as austerity becomes to hit and tax inflow decrease, then lenders perceive the countries as getting a higher risk. They increase the interest rates, and when you have a debt which is 100% of GDP, an increase of 1% in the interest rate implies a larger transfer of 1% of GDP, and therefore, with the given structure of our public debt abroad, 0.4% of GDP each year will go abroad. It's very difficult to say that this can be. What is the 1 minute? Okay. What do these guys think that expansionary austerity will work? I mean, what is the channel they have in mind? The first channel is that if you do austerity, if you reduce your prices and you become more competitive, then you will export more. But if all the countries in the Eurozone are running austerity at the same time, and we know that the majority of trade is within the Eurozone, then this is not going to work, because they will all gain in competitiveness against each other, so the relative position will not change. So who are we trying to sell to China and Brazil? This is possible, but I really very much doubt that they will be able to absorb the exports that are not absorbed by other European countries. If surplus countries like Germany pursue an expansionary policy, then this will solve the problem. In a closed system, of course, if you are a creditor and the other agent is a debtor and there are no other agents in the system, you want your debt to be paid back. The only way the debtor can pay you back is if you buy something from him or her. So if Germany doesn't buy more from the periphery or lend more, you cannot expect that they will be able to repay back the debt. The other idea, which were at the core of the austerity and growth literature, is that you can have asset prices wealth effects, but this is not the case because we just had crashes in financial bubbles, in the housing market, and so on. Or this so-called German view, according to Giavazzi and Pagano, which is that if the government decreases expenditure, it will decrease taxes in the future. So you are rational and perfectly forecast what is going to happen, so you are saving less because you will pay less taxes in the future, and therefore you spend more. So if you believe in it, then you will have austerity and growth, but it's very hard to believe. The other approach, which is more realistic, that we adopt is based on the financial balances, which says that if the deficit, the government deficit is shrinking, this will have an impact on GDP growth. It must be either compensated by an increase in the current account balance, which have just been ruled out, or by an increase in investment over saving out of borrowing. So this is not, again, to be expected. So to jump at the conclusion, it is quite clear that austerity is redistributing income in the way I've just shown you through the matrix. It is not clear at all that it will create growth in the short or the medium term. Mechanisms which have been proposed to solve the problems, such as a rescue fund, will just bounce the debt problem from one country to the other, because if Spain asks for aid, Italy has to pay to help Spain, and therefore the government deficit in Italy will deteriorate, and Italy will have to ask for more funds. Other remedies should be adopted by Germany, but Germany is not politically willing to adopt them. So as time passes, the breakdown of the Eurozone is looking more and more as the less costly solution. And I believe, given the analysis of how much competitiveness deteriorated, that this will imply a devaluation of countries exiting the euro in the order of 20%, and an impact on internal inflation which is way, way lower than what the mainstream is suggested. Thank you.
Very good. So I think we have time for 2 questions, maybe. Have we got questions for Gennaro? Just wait for the microphone. Yeah. You. Yep.
Hi, I'm Sebastian Gechert from the IMK in Germany. It's really interesting because we do some similar work, and I would really like to see your model. Maybe just a short comment, because the current discussion on fiscal multipliers between the IMF and the European Commission is very right on this point, and the IMF is now well, doing some more research in your direction, and they come up with multipliers of about 1.5 by now, because they do actually take into account this this link that you mentioned between the influence of the growth rate on the primary surplus, and this seems to be very important to me. Actually, the European Commission responded by a short note on that, and they simply assumed away this link, and so they come up with lower multipliers. So this is simply the usual story on that. Okay, so that's all from my point.
So Neil, do you want to just hand it down? Neil, do you want to just grab the microphone?
Neil Lancaster from the UK. I'm interested in some of the policy, all the policy prescription, which is, as you presented it, an exit for Italy. And I just wondered if you could comment, if that wasn't possible, on 2 other policy prescriptions, and I'd love to see the model in more detail to go into that. The first one would be Eurobonds, so an ability to reduce the cost of government borrowing whilst leaving household and business borrowing to the market. And the second is whether European countries need different fiscal taxation policies, so particularly around debts and capital gains. So what's your feeling around the debate around greater fiscal union?
Okay, so shall I reply?
Yeah.
Okay, on multipliers, yes, I agree with you. There has been a nice meta-analysis of multipliers. I don't remember the reference, but I can give it to you later, which show that the size of the multiplier depends. It's yours. Yeah. Depends on the theory as well.
How often does that happen? That's very cool. So that was me, actually.
That was a very, very good piece of research. And
I'm feeling the love here. I'm feeling the love. I like your work. I like your work. Can I see your mom? It's great.
And I think that the ECB also published a recent working paper where they admit that the multiplier is what our Keynesians always said it would be, meaning that government spending has a larger multiplier than fiscal transfers, and that when you are in a recession, therefore you are very far from full employment, the multiplier is larger than when you are close to full employment. So in the end, I think that they should agree with us. And on the second question, maybe it will take a little long to respond, but basically the Eurozone institutional setting is incomplete. And this was pointed out before the Eurozone started by many commentators, including Wayne Godley, which pointed out that if you want to have a common currency, you also need a common fiscal system, which will have an automatic mechanism for transferring income from high-income regions to low-income regions, and therefore attenuate the impact of trade imbalances, which will emerge inevitably in any aggregation of regions. And we may add that also a common banking system would be useful or possibly necessary. So if the Eurozone countries agreed on having a common system of fiscal transfers, which would imply larger payments from Germany and the other rich countries to the poorer countries, if we adopted a common system of surveillance of banks and so on, then the Eurozone could work and we could all be happy. But I don't see the political will to do these steps. The Eurobond is not sufficient in my view, because it will only allow countries to get finance at a lower rate, but would not solve any of the underlying structural problems. I think I have to give the floor to Stefano.
Okay.
Thank you.
Well done, the last talk before lunch. Oh yeah. All right, great. I'll be as quick as I can. My name's Stephen Kinson from the University of Limerick. Just brought off the substitution bench when Leanne Ussher couldn't make it. So, okay, 3 stories this morning, and it's all the problem with the Irish economy at the moment is it's all a little bit depressing, do you know? So I promise I will lead you into Mordor, but back out to the Shire again, you know, later on. So don't worry. So I have 3 stories. The first is the interaction between credit and debt. That's the first one that I want to talk about. Then I want to talk about the linkage between private and public debt in particular. And finally, I want to finish off on expectations and reality, the link between expectations and reality, and how it's somewhat tenuous, actually. And the Soros kind of theory of reflexivity, it's kind of playing out in my own country. I should also apologize for my sort of monomaniacal focus on the Irish economy. I live there, and frankly, it's the economy I care the most about. So while I will show comparative stuff for the European case, I'm really most interested in the Irish situation, but I think it's interesting as a case study in any case. So 2 things that you need to know about the Irish economy. First off, in terms of scale, 4.58 million people, 2.2 million people of working age. Roughly speaking, a 15% unemployment rate, that's around 315,000 people. And here is a good measure of demand. There's a big problem with measuring GDP in Ireland because we have a very, very large multinational sector which enjoys transfer pricing to pay less tax, which means that our GDP statistics are blown out of proportion. So our gross domestic product is 160 billion, our gross national product is 130 billion. So when you talk about how much the economy is going, so that's net factoring income from abroad is roughly 30 billion. So here's a good example of sort of demand, quarterly demand. It's about 40 billion per quarter in the peak, and it's about 23 to 25% down from the peak. In a European context, you can see that Irish and EU unemployment rates, we're sustained. There's been a very large rate. So this is the sort of pre-Celtic Tiger era from 2000, or the Celtic Tiger era from 2002 to 2007, an enormous increase in unemployment as basically every construction worker in the country becomes unemployed, and then essentially leveling off at around 14 to 15%, and it hasn't moved from there in the last couple of years. So my first story is the interaction of credit and how credit turns into debt. It should of course strike this should be of absolutely no surprise to anybody that credit and debt are no problem once you can pay it all back, and once somebody's willing to lend to you, there is no issue. The issue, of course, is when it becomes unsustainably large. Here is the increase in total assets and customer loans in the Irish system from 1948 to 2009. You can see that there's been a bit of an increase, putting it mildly, from the 2000s. And you can also see that the residential customer loans were much lower than the total assets in the system. Okay, so we were importing loans from abroad. There was a lot of interlinkages, particularly, and I think we were talking about this already yesterday, between German banks and Irish banks. And so there may be an interesting case study using the flow of funds models developed by the ECB on that. So already we've got some good ideas for the next while. Well, where did this lending go? Well, unsurprisingly, it went into property. So what you're looking at here is the total composition of loans in the Irish system from 2002 to 2011. You can see two important two important categories. The first there is gross fixed capital formation, which you should all read as building houses. Okay, so gross fixed capital formation explodes through that period, and on the other side of that balance sheet are loans. So the first and most important linkage is the link between credit and debt. This build-up was unsustainable. It was well flagged by many people, and it was also equally well ignored by the people who were gaining from the process, which was, frankly, everybody in the system. Nobody had any particular reason to stop it. In terms of the ratio of disposable income to debt, Ireland is there at 210% at the moment. You can compare the UK, the USA, and Spain. Roughly speaking, it's really interesting. The UK's talk about we're the most indebted nation in the world, etc., etc. No, not really. But as interesting as these percentile measures are, or percentage measures are, it's even more interesting to break it down and see what components of that household debt figure show the explosion. The green line there is household disposable income. The red line is household debt. What you can see is that it was the debt that was accumulating the whole time. We were building up a massive amount of debt in the system, and most of that debt was coming from abroad. We know this because we know that the ratio of domestic loans to foreign loans was very, very high in the 2006 to 2008 period. So, and you can see the effects. So, net borrowing explodes from 2002. It's the green line there. It explodes and then collapses straight down. So you can see it's kind of negative now. Net wealth collapses, consumption collapses, and disposable income collapses. So it's been a pretty unpleasant time to be Irish. Although most of the time it's pretty unpleasant. We do bitterness and squalor quite well, so that's good. I expect that this will be a Keynesian stimulus program for Yeats level poetry. Actually, we tend to do misery quite well. There'll be a couple of Nobel Prizes coming out of this period. Another interesting puzzle, which I'm just investigating at the moment, is the interaction between gross saving as a percentage of disposable income, which is that red line, and the debt to disposable income line. So what's really interesting is the post-2010 divergence in the savings rate as people attempt to deleverage, but they can't because the debt levels are simply too high, which is exactly what Gennaro was talking about earlier on. We have this other really interesting chart, which is the comparative context. So what you're looking at is the 100 there is the peak GDP series. So for similar countries at similar crises, you can see how long it took them to recover. So for example, there's Finland, here's Sweden, and there's Ireland. So we're still not even, I suppose, halfway back to normal. And it also means that there's going to be a lost decade for the Irish economy, which is putting it frankly, a bit of a bummer. So, and I use that in the technical sense. So here, another in comparative context is the year since the peak of the housing market. So you can see the green line there, straight down, absolute collapse. The reason for the collapse: excessive concentration of lending, an extremely large loan book, very poor regulation. If you can name it, we did it wrong. Name a thing in the Irish system that we should have done, we didn't do it, bar lend the rest of it. So that's the first interlinkage, the interlinkage of credit and debt. Now, we also have an interlink between private and public debt. Ireland, the Irish finance minister in 2008 guaranteed the assets and the liabilities of the entire banking system in that period. Just to give you a sense of scale, the GDP of Ireland, 160 billion, total assets and liabilities of the banking system, 440 billion. So with a pen stroke, he made the entire economy insolvent, which was kind of shocking at the time. But he critically confused the liquidity problem with the solvency problem. And here's a model that we're looking at to think about the Irish system. Here are the kind of interlinkages that we're trying to model. You've got the balance sheet channel, the lending channel, the real channel. And you can see, obviously, in the Irish case, you have to consider the rest of the world as a serious issue. And so when we're considering interlinkages with these stock flow models that we're building through our INET grant, this is the kind of thing that we're considering and we're trying to model. But because of this increase, because of the connection of the private sector debt and public sector debt, this necessitated an enormous increase in our debt to GDP ratio. Again, remember, GDP is 160 billion, GNP is 130. So already we're at Greece levels of debt to GNP. Anyway, you can see the huge increase in government debt, and you can see where it's coming from. It's all coming from the massive increase in debt and the collapse in GDP. That debt itself is now coming from loans from the EU and the IMF. After 2010, nobody was willing to lend to us, so we went into we embraced the clammy hands of the Troika, and we came in. And so those purple lines are basically the EU IMF loans. And you can see that right now the composition of the government debt is about 108% of GDP, about just over 168 billion. And it's projected to level off by the EU and the IMF at 122% of GDP. If it actually stays at 122% of GDP, I have a bet with a friend in the European Commission for €100. It's not going to. It's going to keep increasing because of the austerity issues that Gennaro was talking about. So we had this old school idea. By the way, if you know how this object and a pencil interact, you are of a certain age. You are of a certain age. I put this up on a screen for my students, and they were like, yeah. So we had this old school idea, and it goes back quite a long way. It goes back quite a long way to the empirically founded stock flow consistent models that Gennaro uses, but that were principally developed in the Treasury by Wynne Godley and Francis Cripps, also at Cambridge. And so we built this model. We started in January of this year, myself and Tiu Tagbailiti, who's a postdoc working with me in Limerick, and we built this little model. So we have a couple of sectors: non-financial corporations, financial corporations, the government, households, and the rest of the world. I won't go through it all, but essentially what we do is we map the stocks in the economy to the flows, we make the whole thing consistent, we set up a series of behavioral equations, and then we simulate that model using real world data. This is the important and extra contribution that we're making here. And so here's what we did. We did a simulation, and we said what would happen if we front loaded all of the austerity. So if we just did, if we believed the expansionary fiscal contraction nonsense, so we said, right, do all the austerity, what's going to happen? So we worked out that the Irish government per quarter cut 881 million out of the economy, and we said, right, what happens if we do that every quarter from the start? So the green line is what actually happened, the blue dashed line is what would have happened. And because we were modeling the interlinkages, we're able to see it. So I'm just going to show you two sets of charts. One is on households, the other's on the government. The black line is the actual value that really happened. The blue line is the shock. And you can see, first off, household deposits held by financial corporations more or less collapsed. People tried to get their money out as quickly as possible. Obviously, the government and the rest of the world stays reasonably the same. We have household loans drop massively because of the austerity. And the financial corporations seem to be more or less okay. Similarly, government obviously borrows less, so that's good. It's borrowing less because it's spending less, so that's good for the government. However, there is still a solvency problem, and there's still a sustainability problem because the taxable income in the system has collapsed. So, third and final story: expectations and reality. So we were able to, with using these stock flow models, modeling interlinkages, we're able to see how these things change in the system. But what's really interesting is the political economy aspect that Stefano was talking about, and the psychological aspect, I think, that maybe very few people really have a sense of. So this fella here is our Prime Minister. His name is Enda Kenny. He was on the cover of Time last week, and he got an award from Germany for being the best European. Literally, the best European. The Celtic comeback, it's called. And just to give you a sense, I can go back and show you that debt, the unemployment level hasn't changed. The debt level is still unsustainably high. We're really worried about our foreign direct investment. But no, we're the Celtic comeback. Here is one of the headlines from yesterday's Financial Times. Ireland lifts the Eurozone debt crisis gloom. We're doing okay. here's what happened to our 9-year generic bid yield. So this is a kind of a measure of how investable they see the country. And so this is from December last year. And you can see that it's just been falling straight away. The June summit where they agreed to separate Ireland's banking debt from its sovereign debt, or no, actually they didn't agree to do that. They agreed to examine how to do that. So there's a big difference. But anyway, we're glossing over all this sort of stuff, and things are fine. And what's really interesting is that the perception is that we're doing fine. And so if the perception is that we're doing fine, and that means that somebody's willing to lend to us, then perforce we are doing fine. Because as I said at the start of my talk, if somebody is willing to lend to you, you're fine. There is no issue. And so it's a very, very interesting problem for a modeler, because you can't put that into a model. It's a really, really interesting issue. One other issue is the notion of national psychology and how it's been affected by losing our sovereignty, but also by this notion that we don't really have control of our destiny in any real sense anymore, and the European sovereign system is all. Irish people have a black sense of humour, and so when we went to the European Championships, this was what my students put up. Yeah, they're all University of Limerick students. So there's this expectations versus reality issue. She thinks we're at work, but we're not. All right, so I'll leave it there. Thank you very much. So I think we have exactly 1 minute for questions. But we have quite a while for lunch. So if people want to talk, that's great. And if people don't, feel free to go, because I understand you've been there for a while.
I'm Andrea Roventini from the University of Verona. I have a general remark about the multiplier, which I think have a central role in all the crises in the Eurozone. We are running an empirical analysis where we use a nonlinear VAR, to check what's the size of the multiplier when financial markets are under stress, and for the stress we consider a measure of the spread between the interest rate paid by private firm and government bond. And what we found is that usually in periods in which financial markets are under stress, which actually is the case now, the fiscal multiplier increase are very high actually. So this in a way is a good news, but given the policy that we are pursuing in Europe now is a very bad news, because the effect of austerity will be magnified in a country like, for instance, Italy or Spain, where the spreads are very high.
Yeah, the issue of multiplier is very important. I mean, I think it's now. I think maybe even you coined the term, the battle of the boxes. Basically, it box 1.5, and every thing is now what's the multiplier. The interesting, there was a very interesting report from the National Economic and Social Council in the UK, showing that of all the countries in the Eurozone, the only one that would benefit from austerity is Ireland, because of its very high, very low fiscal multipliers, simply because of its openness. So what's really interesting about these multipliers are that they're crucially related to the level of unemployment and how far you are away from your equilibrium. So I wonder, is there a better way to model just the nature of the multiplier process in a disequilibrium state? So if you are at 15% unemployment, then, and you have some fiscal space, which I agree Ireland and Greece don't have, does it not behoove you to spend, given that your multiplier is anywhere above 1? I wonder, there's a technical argument, there's also a moral argument, I think, for that. But I'll agree that there are greater experts than me on this in the room, so maybe I'll let them comment.
A very important part of what you're talking about was that decision to honor the bank creditors, the bank debt, 100%. Mm-hmm. Have you modeled, or has anybody in Ireland done a counterfactual modeling of what if that had not been at that 100% rate.
Yeah.
And the dynamics of that.
Sure, and we did is the answer. So I just showed you one of the great things about these models is when you get them set up, you've just basically got a huge series of buttons that you can push. It's great. So one of the things that we did was we simulated bank default because in the system we assumed away the guarantee. What happens is 3 of the 6 major banks default, taking their deposits with them. And so what's really interesting about this is that unless you can imagine that the government would guarantee the deposits of the banks, and actually there's a European directive that they are guaranteed, but only up to I think 36,000 euros. With the level of indebtedness that people had, the banks would have still gone under. The bondholders would have certainly been burnt to a little crisp. But the interesting thing about this interlinkage perspective is who are the bondholders? So nobody has any particular problem with burning Goldman Sachs. In fact, some people would actually enjoy it. But people do have a problem with burning pension funds. I think we didn't model the effect of the pension fund industry on this. We just saw what would happen to GDP. The banking system, so it wouldn't have cost us 64 billion, which is what it ended up costing us, or to date it has cost us at a minimum. But it certainly would have probably tanked half the banking system and caused a 10% drop in GDP anyway. Simply because of the shock, and that's not to say anything about the credit crunch or the effects on the other banks, which we didn't model. We didn't model the credit channel that the other banks were getting. They would still probably all be on life support from the ECB.
So that would be with a haircut determined by the market,
yes.
Not, just a decree of. 70%.
Well, I think without a doubt, the subordinated bondholders would have gotten zero. Even probably the senior unguaranteed guys would have taken a haircut. The super seniors no, but I think there was certainly enough money. There's about 90 billion of outstanding bonds in 2009. I think there's 2 billion now. So there's no point to doing it now. But you would have saved potentially 45 billion euros. Something like that, which is not inconsiderable for a GDP of 160. Thank you. Okay, I hope that you've all learned something. I certainly have, and thank you very much for coming. And thank to Gennaro and Stefano for speaking. Cheers. Thank you. Cheers.